Hey there, everyone! Welcome back to our channel. If you're new here, I'm Your Name, and today we're diving into two of the most talked about investments in the financial world, stocks and bonds. Whether you're looking to invest your hard-earned money or just want to understand these concepts better, you're in the right place. So, grab a snack, get comfortable, and let's get started. Now, you might be wondering, what exactly is the difference between stocks and bonds? Are they the same thing, or do they serve different purposes in the world of investing? Great question! Let's break it down. First up, let's talk about stocks. When you buy a stock, you're essentially purchasing a small piece of a company. This means you become a shareholder, which gives you a claim to a portion of the company's assets and earnings. For instance, if you invested in a company like Apple, you own a fraction of that tech giant. The more shares you buy, the bigger your slice of the pie. Now, here's the exciting part. As the company grows and becomes more profitable, the value of your stock can increase. If you bought Apple stock at $100 and it rises to $150, you've made a profit by selling it. Plus, many companies distribute a portion of their earnings to shareholders in the form of dividends, which can provide a nice income stream. However, there's a flip side. Stocks can be volatile. The market can swing dramatically based on company performance, market trends, or even global events. Just think back to the COVID-19 pandemic. Many stocks plummeted in value at the onset, only to bounce back later. So, investing in stocks can come with a greater risk, but it also offers the potential for higher rewards. Now, let's switch gears and talk about bonds. When you invest in a bond, you're essentially lending money to a company or government in exchange for regular interest payments, plus the return of your principal when the bond matures. Think of it like an IOU. You give them money now, and they promise to pay you back later, usually with some interest along the way. For example, let's say you buy a bond from the US government worth $1,000 with a 5% interest rate. That means every year you'll receive $50 in interest until the bond matures. When it matures, you get your original $1,000 back. Bonds are typically considered safer than stocks, especially government bonds, because they provide a fixed income and are less susceptible to market fluctuations. However, that safety comes with a trade-off. The potential returns on bonds are usually lower than those on stocks. If you're looking for aggressive growth, bonds might not be your best choice. Now, let's summarize some key differences: ownership versus loaning. With stocks, you own a part of a company. With bonds, you're loaning your money to the issuer. Risk versus safety. Stocks are generally riskier, with the potential for high returns, while bonds tend to be safer, providing more stable but lower returns. Income generation. Stocks can offer dividends, while bonds provide fixed interest payments. Both stocks and bonds can be important parts of a diversified investment portfolio. Many financial advisors recommend a mix of both to balance risk and return. To give you an example of how these investments can perform over time, let's take a look at some historical data. According to historical averages, the stock market has returned about 7% to 10% annually over the long term, whereas bonds have returned around 3% to 5%. So, if you had invested $10,000 in stocks 30 years ago, it could have grown to over $100,000, whereas the same amount in bonds might have only reached around $30,000, depending on the bond type. So, there you have it. Stocks and bonds are two different types of investments, each with its own advantages and disadvantages. Understanding these differences can help you make informed decisions about your financial future. If you found this video helpful, please give it a thumbs up and share it with your friends who might also be curious about investing. Don't forget to subscribe for more educational content like this. And, as always, if you have any questions or topics you'd like us to cover, drop them in the comments below. Thanks for watching, and happy investing! See you next time!